Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Thursday. It's May 5th. I'm finally starting to realize that summer may be right around the corner. I just don't know where the year has gone. And it was 90 degrees here yesterday, so it certainly felt like summer. It's about 8:04. The market's going to open up in about an hour and 26 minutes. I'm off to a little bit of a late start today. As you can see here, the volatility just doesn't stop coming. Markets rallied really, really hard yesterday. I mean, we had the biggest S&P move in 2 or 3 years. I'll get into the news in a minute. But as you can see here, we're starting out on a low note. We're down a little bit today. But honestly, let me be very straight with you. I would be a little concerned if the market opened up higher after what we saw yesterday. And a little bit of a reprieve is very, 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 very normal and very healthy. You don't want the market to go from being stretched out like a rubber band to the downside to the same thing to happening to the upside. But the fact that we're opening a little lower is really not that bad. And also, typically this type of volatility, or looking at the NASDAQ down 100 points at the open, would be significant. But when you consider, let me just show you a graph, when you consider the type of volatility we've been having, and I mean we've been having some volatility, it's just not all that much. It really isn't. I mean, it's not. But we took out the high. We took out a recent high, or we're right at that recent high, which is good. It took out the last 3-4 days. And I think on the QQQ, let me see if I'm right. It looks like we cleared a several days high. 1, 2, 3, 4, 5, 6, 7, 8. So I'm hoping we're going to hit the 50-day moving average over the next few sessions. It's still a little bit bumpy around here. But again, keep your eye on the bond market. Notice yesterday we had the Fed, and even though we're down right now, 0.64, notice it looks like it's starting to move more sideways and less downwards. That's very, very important, and that's taking into account pretty much what I was saying yesterday, how the long bond has assimilated most of what the Fed wants to do. And what did our head of the Fed say yesterday? He was sheepish. He was dovish on 3/4 of a rate hike, which means we may hold in this area because this market might have already started taking into account 3/4 of a point rate hikes, where we are not going in that direction. That's as clear as day. Now, yesterday we had the FOMC, the Fed chair, Mr. Jerome. I'm going to predict the future. Oh, wait till I can't, Powell. Today we've got jobless claims. Not a big report. The numbers have been very, very solid. Not expecting anything crazy there at all. And then tomorrow we're going to have the employment situation. That'll be pretty important because I want to see if people are starting to go back to work at a higher clip or not. But jobless claims have been pretty solid. They haven't been really all that bad. They've been really, really good. So even if the number's off a little bit, it's not going to be a big, I'm telling you from my experience, this has been very, very solid. Not expecting anything major today. I think the market is still going to see some follow-through trading action based on what we experienced yesterday. And we still have earnings. These are all the companies that are reporting either before the opening today, during the market session, which typically does not happen. I just threw it out there, or after the opening or after the closing bell. And I don't know when, but if you see a stock that you own here, you may want to take a look on Yahoo and just see earnings date. It'll tell you after close. But we've got Air Lease, AMC Network. This will be interesting. You've got Cardinal Health. Very, very interested in seeing how that one turns out. You've got Cloudflare. That was a really hot COVID stock. You got ConocoPhillips. That's really, really big. That's energy stock. We're long this stock right now. You've got Crocs. Crocs, folks. Crocs. All eyes on Crocs. This was the biggest retail play last quarter. We did not do well on this stock at all. You've got EOG Resources, a lot of resource stocks coming out. You've got GoPro. That's an interesting one. Haven't seen that one in a while. Kellogg's, that's good. Very good to see how consumer staples are doing, some of my favorite stocks. You've got Live Nation reporting. You've got Marriott Vacation Worldwide, Nikola. Just kind of going through these just to kind of show you what's going on. Penn National Gaming. So as you can see, we're getting pretty broad. Quanta, utilities company. Chuck likes this stock. Chuck Hughes, he was talking about it. Royal Caribbean will give us a preview. SeaWorld, so we've got the summer stocks. That'll be very interesting. You've got a lot of market cap today in various sectors, which means the market can really move. You've got Zillow. You've got ZTS, you've got Worldwide Wrestling, you've got Wayfair. That was also a really hot COVID stock because people were buying furniture and shipping it to their houses. They weren't going out. SunPower, great stock. Shopify. This will give us some clues on how the retail, sale, and communication sector is going. So a lot of stocks. And on the right, you see what their earnings per share estimates are. So that will be seen there. Volatility started really cooling off. I think we're break even or maybe even a few points higher. I'm waiting for this volatility to come back down to the 22, 23 level. Would like to see volatility come a little lower. It's a little higher this morning because the market's off, but we went from 33 to 25 in the last 2 days, which is very, 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 very significant. Now, looking at sectors, no major change. You've still got energy, consumer staples, utilities. You need to stay that course. On the weak hands, you've got the communication and consumer discretionary. These are the weaklings, and we now have fragmentation again, which means the market's going to be doing its thing. Now, looking at the chart, I want to give you some very, 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 very important levels right now. I think, if anything, we need to break the 50-day before we go any higher, which would put us right around the 347. So keep your eye on the 347 level on the Dow, on the QQQ, on the Dow. Keep your eye. Look at this. I mean, this is great. I love this. Keep your eye. The next stop is 200-day line. Probably not going to hit it today, but I'd love to see us fill in this gap here. But this looks beautiful. 350, 349, next stop. Remember I told you about this divergence? Oh, actually, I was talking about this divergence on the Q right here. Remember I told you this divergence typically leads to a rally, and we had the biggest rally in 3 years yesterday. Just saying. And if you look at the SPY, so again, this is what we made yesterday, and this is where we're at now, which, I mean, if you consider this isn't really anything. Next stop is the 436.79 level. It'd be great to break this level, and then we can see the 200-day line. Again, markets are not bearish. They're choppy right now. Let's talk a little bit about global economy. Global stocks rose Thursday after Federal Reserve Chairman downplayed the likelihood of a bigger interest rate hike following the U.S. Central Bank's biggest increase in 2 decades. He downplayed. He was dovish. He wasn't bullish. S&P gained 3%, biggest one-day increase in 2 years. I'm going to repeat that. Its biggest one-day increase in 2 years. Now, folks, when markets go bear, stocks don't have a 3% increase in 1 day. That's a market that's in play. That's not a listless dead market. That's the opposite of a listless dead market. The Federal Reserve raised its key interest rates Wednesday by 0.5 percentage point, double its usual margin. But here's what I was talking about. Powell said that the U.S. Central Bank is not actively considering a bigger increase. Well, that's not what I heard a few weeks ago, and that's what the bond market, I think, was assimilating. So if we go a little bit higher, it wouldn't be a surprise. Powell's comments appear to be aimed at easing fears that the Fed, which was accused of reacting too slowly as inflation surged, and they were, might be headed for an unusually large rate hike of 0.75 percentage basis points at its June meeting. That's not going to happen. The Fed announced details of how it will start reducing its holdings of Treasury debt, which has been planned for a long time, mortgage-backed securities. The central bank has been buying bonds to pump money into the financial system and push down long-term interest rates. And that hasn't been working lately because interest rates have been going up because bonds have been going down. Bonds down, interest rates up. Complete inverse relationship. But again, let's see if we can stay in this box a little bit and not move away from this market capitalization. Again, volatility appears to be heading down. A couple of hiccups wouldn't be surprised, but I think the worst is behind us. Now, today is Thursday, and on Thursday, I give you my top ETFs and option picks. So let's look at my ETFs right now. I'm looking at global ETFs. Energy are going higher, but consumer staples and utilities still look good. So right now, out of all the sectors that I'm seeing, I'm going to tell you what I really like right now. I like the basic materials. I love the basic materials right now, especially in light of everything this country's going with and in terms of everything the world is going with, basic materials. Let me show you the ticker symbol here. It's XLB. This is all-time high, 92. Then we went to 91. Now we're at 88. And this is not all that far off. We're above the 200-day and the 50-day line, but we don't look overbought just yet. So I think we may go higher on the basic materials. I like XLB right now. You may want to wait for a day or two because, I mean, we had the biggest biggest move in the S&P in 2 or 3 years, as I just read. But you may want to wait a little bit. I'm in no rush, but I like this sucker a lot right now because think about it. If a rebuilding economy, you need basic materials. All this stuff in Ukraine, the war is not going to last another 3 years. I don't think it's that kind of a war. I think Putin's got something. I think we're getting close to the end. I would look at August. I would look at maybe the right here, 87s, 88s. They got plenty of. You don't have to go that far here. You can go to July. July's got a little more open interest, but you'll find a good spread here. They're not that bad. They're reasonable. Just use limit orders. Don't use market orders. Historic volatility is 21. We're at implied 17. So implied volatility is lower than historic volatility, which makes these options not overly expensive. And even though the market's down, they're already up 3% today pre-open. So again, I like basic materials. And I think right now with inflation, nobody's going to skimp on basic materials. People are still going to need base. That's why it's called basic materials. I think with all of the destruction, all of the stuff that we went with COVID, this rebuilding infrastructure that Biden wants to do, all of the cement, the materials that are going to be going from here to Europe, oh my God, over the next couple of years, I think we're gearing up for a very strong basic material sector. And I like this sector quite a bit right now. So I would go probably for July or August calls around the 85, 88 strike price. Let me just take another look. I want to make sure I got you guys covered here. Let's go 715. Let's go to 88, 89. So we're at 88. Yeah, you'll probably be able to get these. Once the market opens, the spread will tighten on these. So again, and wait for a little pullback because the market went crazy yesterday and it's going to open up hard. So everything is very spread right now. Wait for a little concentration. The bid and offer will go in. But again, 88, 89, these two right here for July expiration look really, really good. Now, before you're even thinking of going anywhere, I want to tell you guys something. Don't try to be a hero in these markets. And don't try to time bottoms. All right? You'll get your fingers dirty because there's going to be some fallout. There's just no question about it. It's inevitable. In fact, there are multiple crashes coming, according to former $700 million hedge fund manager Jeff Zananeri. He's been trying to warn traders for weeks about it. And he's going live 1 p.m. Eastern Time, Jeff Zananeri, 1 p.m. Eastern Time, to reveal a unique opportunity to play both sides of the market. And right now, you really should play both sides of the market. Because if traders aren't primed to take advantage of market crashes, they could be left on the sidelines watching the grand slam opportunity of the decade pass by them. Bye-bye. You don't want to do that. You don't want to let it pass by. Don't. People let too many opportunities pass by them. Click the link below to learn more about Jeff's predictions and to attend his live presentation today. Follow the link below. And tomorrow, biggest winners, biggest losers of the week. Send me some love letters. Support at marketgeeks.com. I want to hear from you. I miss you. I'm a little lonely out here. It's a lonely world out here. Follow the link below. If you can't find the link, you could find the link to Jeff's class in the YouTube Wealth Press channel. It's there. If not, you can find it below this video. And again, comments, feedback, love letters. I want to hear from you. Bye, guys. Good, bad, and ugly. I'll take it all. I have a thick skin. Last time I checked. Bye, guys.